Happy Friday, everyone. I'm going to give you all a warning. This is going to be a little bit longer update. I kind of wanted to just take a deeper dive into some of the technicals as far as interest rates are concerned. So if you don't have 3 minutes, then sign off because this will probably bore you. But um, for the rest of you that want a little bit more information about what's going on with rates, I hope that you guys find this helpful. So I've got the 30-year mortgage coupon graph, and just a quick reiteration, the 30-year mortgage bond or mortgage coupon is the closest index in the marketplace to mortgage rates. So when we see it higher on the chart, like you're looking at, the higher on the chart, the lower rates are. And so it's an inverse relationship with rates. And it's the closest index that mortgage economists or anybody tracking rates, as we try and give advice to clients, it's the best index and the best indicator of where rates are going and what we see as lenders on our rate sheet. So when we see movement, which is, the green and red candlesticks, that's daily movement. When we see that, that directly impacts our rate sheets, and sometimes that's multiple times a day. So I just have last quarter graphed, and I really wanted to focus. I drew kind of the downward trend line, which would mean upward in rates that we've been on since the beginning of August. And what's really made headlines this week was the inflation report for August, which came out higher than expectations. So that was on Tuesday. So if you look at this big red candlestick, that furthered the downward trend line that we've already been in, but the inflation report came in higher than it's expected. And inflation has been the number one enemy of long-term interest rates. So we aren't really going to likely see mortgage rates turn around until inflation, we start getting better inflation readings. So I get the question, when is that going to happen? And that's really hard. I think a lot of us were hoping that it would happen sooner than we're experiencing as we head into the fall. So, if we look at the charts and the trend line that we're in, we had last September of 2021 a pretty low inflation reading. So when we compare inflation year over year, so when we get to October, beginning of October, and we're comparing inflation for the year over year reading from September of 21 to September of 22, it's going to be hard for that to be a good report because September of 21 readings were pretty low. So it's probably going to be into October that we see rates really start to improve. When we get the October of 2022, comparing that to October of 21, that's going to look a lot better than the September inflation report. So there is a chance next week that we repeat what happened in June. So I'm going to bring the charts here back to June of this year. And if you can see here in the middle where I've got my cursor, we had this huge change in rates in June. This is when they hit 6.25 back on June 14th. But what sparked this quick rise in rates was the May inflation report. So we're having an almost repeat scenario. So May inflation report comes out around June 10th, and rates are just before then, and rates go up as you see bond prices here going down. And then what happened on June 15th? Well, June 15th was the conclusion of the 2-day June Fed meeting. And in that Fed meeting, they surprised the markets with increasing the federal funds rate by 75 basis points instead of 50 basis points. So the federal funds rate, the reason we saw that rally starting on June 15th was that in the bond market, traders were seeing that the Federal Reserve's increase in the federal funds rate. Again, the federal funds rate does not have anything to directly do with mortgage rates. The federal funds rate is what banks borrow from each other on an overnight basis. So that's why credit cards are going up. That's why auto loans are going up. Home equity lines, those are affected because it's short term by the federal funds rate. That's why home equity lines have gone up. So why did mortgage rates improve on June 15th when the federal funds rate was hiked higher than expected? Well, that's because the markets and the bond traders saw, hey, the Federal Reserve is taking inflation more seriously. How does that work? Well, if they hike the federal funds rate faster, that should, in theory, and they've done this they did this in the early 80s, they did this in the mid 90s, that should lower inflation eventually. That's why the bond market rallied, and we saw mortgage rates go from 6.25 all the way to 5.125, and you saw some lenders at 4.99 on at the beginning of August, and that psychologically that was like, okay, let's get everybody back on the market. But will that happen again next week? That's what everybody's kind of waiting for. Does the Fed hike more than 75 basis points? The expectation at this moment is for next week, Wednesday of next week, that the Fed hikes rates 75 basis points. So we shall see next week if that actually marks a change in rates. I think that the more likely scenario of rates really making a turn will be after we get through the September inflation reading, which is going to be further into the month of October and November, because like I mentioned earlier in this video, September of 21 had really low inflation readings. So again, when we compare it year over year, I think we'll probably see a higher than expected inflation report for the month of September. Again, time will tell. We won't get that report until the beginning of October. But at least in the short term, we may see some relief next week, depending on what the Federal Reserve does, and also what the Federal Reserve's comments are will be extremely important for where rates are heading. Because if the Federal Reserve actually can acknowledge that we're in a recession and likely heading there, and that they're willing to continue to combat inflation with the federal funds rate, that's probably going to be good news for the bond market, which is going to affect mortgage rates. We should see them lower. But if the Federal Reserve, kind of, which they've done before, if the Federal Reserve, comes in with some of their comments after the meeting and says, hey, we're still having a hard time with inflation, we're struggling to get it under control. If that comes out of the next meeting, then it's not going to be good for interest rates, and we may see them move even higher. But I'm not hearing a lot of people talk about that, hoping that the Federal Reserve can at least instill some confidence in the markets that they're dealing with inflation, and so that will give us a better determination next week. So if you look at the charts here, is the damage done from this recent rise in rates? I'm hoping that we've got this level here, this 99.375 here, that holds. That would keep rates at this 6.375 on the average 30-year fixed right now. They may hit 6.5, hoping that next week doesn't proves that we can either stay flat or mark a turn in rates. I'll give another update next week. Sorry for the length of this video, but I hope you guys find it helpful as far as some of the things that are going on that will drive rates, and then ultimately, kind of looking further ahead, the ultimate outcome of the federal funds hiking rates is a recession, and ultimately, there's lots of argument whether we're there or not, and whether the Fed will even admit that we're there. I won't go into that on this video, but historically, when that happens, if we move into a recession, we should see rates come down. I've not heard anybody talk about threes. I'm hearing high fours, but that's likely going to take 12 to 18 months further into a recession before we really see rates turn. So we will see what happens. I will give you guys an update after the Fed meeting, and hope everyone has a great weekend.